In the spring of 1720, Sir Isaac Newton, the man who codified the laws of gravity and fundamentally altered our understanding of the physical universe, surrendered to a different kind of invisible force. He invested in the South Sea Company. As the stock soared, driven by speculative mania, Newton sold early and took a massive profit. But as the euphoria intensified and his friends grew unfathomably rich, his discipline broke. Newton bought back in at the absolute peak. When the bubble inevitably collapsed, he lost an estimated £20,000, equivalent to millions today. Reflecting on his ruin, he allegedly muttered, "I can calculate the motion of heavenly bodies, but not the madness of people." If the architect of classical physics can be decimated by financial markets, what hope does the beginner have? The truth is, intelligence does not equal financial survival. Most beginners enter the market believing it is a simple calculator, a place where good companies go up and bad companies go down. In reality, the financial market is a highly evolved adversarial ecosystem. It is a discounting mechanism designed to transfer wealth from the impatient to the disciplined, and from the uninformed to the systemic players. Today, we are going to dissect the unseen engine of the global markets by examining the 5 fundamental systemic mistakes every beginner makes. We are not talking about superficial errors like forgetting to diversify. We are going to explore the masterclass mechanics of risk, time, liquidity, counterparties, and macroeconomic history. By the end of this, you will no longer view the market as a casino, but as a complex machine, and you will know exactly how to avoid getting caught in its gears. To understand why beginners lose money, we must define the core mechanics of what an investment actually is. Let's look at the first 2 fatal errors, which stem from fundamentally misunderstanding how the market prices reality. Mistake number 1, mispricing the risk premium. Beginners look at a stock or a high-yield bond and only see the nominal return. They see a 10% yield and think they are outsmarting a savings account. But in economics, there is a concept called the risk-free rate, usually represented by the yield on a U.S. Treasury bond, which is backed by the taxing power of the American government. The risk-free rate is the gravity of finance. Everything else is priced in relation to it. If a Treasury pays 4% and a corporate bond pays 7%, that 3% difference is the risk premium. It is the precise mathematical compensation you are receiving for the probability that the company will go bankrupt. Beginners constantly chase yield without realizing they are essentially selling disaster insurance. They are picking up pennies in front of a steamroller, utterly unaware that the extra return they are celebrating is just the market's mathematical warning sign. Mistake number 2, duration, mismatching. Imagine you are building a massive steel suspension bridge, a project that will take 10 years to complete. Now, imagine you finance this construction by taking out a loan that you must repay in full every 30 days. What happens? The moment credit tightens, you cannot roll over your loan, and your half-built bridge collapses. This is duration mismatch, and beginners do it constantly. In finance, duration measures how long it takes for an investment to pay you back. Stocks are inherently long-duration assets. A company's valuation is based on the discounted sum of all the cash it will generate from now until the end of time. Yet, beginners routinely take short-duration capital, money they need for a house down payment in 12 months, or an emergency fund, and put it into long-duration equities. When the market inevitably experiences a cyclical 20% drawdown, the beginner is forced to sell at a loss because their personal timeline no longer matches the asset's timeline. They didn't lose money because the asset was bad. They lost because they misaligned their capital's expiration date with the asset's volatility. Now we move from the foundational mechanics to the hidden plumbing of the market itself. This is where the institutional players, hedge funds, market makers, and sovereign wealth funds operate. And it brings us to our next 2 mistakes. Mistake number 3, the illusion of continuous liquidity. And when a beginner looks at a brokerage app, they see a price flashing in green or red. They inherently assume that this price is a guarantee, that if they want to sell their shares, they can instantly exchange them for cash at exactly that number. They assume liquidity is a constant state of nature. It is not. The price on your screen is simply a historical record of the last transaction. It is the footprint of a trade that has already happened. Beneath that price is the order book, a list of buyers bidding at lower prices and sellers asking for higher prices. In a calm market, the gap between them, the spread, is tight. But liquidity is a coward. It disappears at the exact moment you need it most. Imagine you are holding a heavily hyped microcap stock. Bad news breaks. Suddenly, all the buyers pull their bids from the order book. The price on your screen was $50 10 seconds ago, but right now, the highest willing buyer is offering $20. You try to sell, but you slide down the order book, creating a cascade of falling prices. Beginners think they own an asset worth $50, but wealth on a screen is just a hallucination until you actually cross the spread and convert it to cash. Mistake number 4. Ignoring the institutional counterparty. The market is a zero-sum game of information and execution. Every time you buy a stock, someone else is selling it to you. Have you ever asked yourself who is on the other side of your trade? Beginners operate in a vacuum, assuming they are just buying a piece of a company. But let's walk through the chronological sequence of a market top. First, institutional smart money identifies an undervalued asset. They accumulate it quietly over months, carefully hiding their tracks so they don't drive the price up. Eventually, the company's fundamentals improve. The financial media catches wind of it. Newsletters blast out buy signals. This is when the beginner enters the arena. The beginner buys aggressively, driving the price vertical in a state of euphoria. But remember, the institutions who bought at the bottom now have billions of dollars in profit. They cannot simply hit sell all, or they would crash the price of their own asset. They need a massive influx of buyers to absorb their shares. In the institutional world, this is called exit liquidity. The retail frenzy is exactly what the institutions use to unload their positions. The beginner is buying the exact shares the smart money is distributing. The beginner assumes the parabolic chart means safety. The institution knows the parabolic chart is a structural trap. To truly understand how devastating these mechanical misunderstandings can be, we have to look at macroeconomic history. This brings us to the final and perhaps most dangerous error. Mistake number 5. Macro regime recency bias. Beginners project the recent past indefinitely into the future. They assume the economic environment they first started investing in is the permanent state of the world. Let's look at the Nifty 50 era of the early 1970s. The Nifty 50 were a group of ultra-reliable blue-chip American corporations, companies like Polaroid, McDonald's, and Disney. They were dubbed one-decision stocks. You buy them and you never sell them, regardless of the price. Because the 1960s had been a period of strong growth and low inflation, investors bid these companies up to astronomical valuations, sometimes paying 80 or 90 times a company's annual earnings. But the macro regime was shifting. In 1973, the OPEC oil embargo hit. Energy prices skyrocketed. Suddenly, inflation tore through the global economy. To combat this, central banks were forced to raise interest rates aggressively. The cost of capital exploded. What happened to the impenetrable Nifty 50? The foundational math of the market changed. Because the risk-free rate was now much higher, investors demanded much higher returns from stocks. Valuations compressed violently. Between 1973 and 1974, blue-chip stalwarts like Disney and Coca-Cola lost over 50% of their value. Polaroid lost over 90%. The companies didn't go bankrupt. The macroeconomic regime simply repriced their reality. We saw the exact same phenomenon play out recently. Throughout the 2000s, we lived in an era of zero interest rate policy, or ZIRP. Money was essentially free. In a world with zero yield, investors were forced further out onto the risk curve. Beginners who entered the market in 2020 or 2021 thought they were geniuses because every speculative tech stock and digital asset was skyrocketing. But they didn't realize they were just surfing a wave of unprecedented global liquidity. When inflation returned in 2022, the Federal Reserve hiked interest rates at the fastest pace in modern history, taking the cost of capital from roughly 0% to over 5%. The gravity of finance was turned back on. The duration mismatch was exposed. High-growth tech companies, whose profits were projected years into the future, were mathematically decimated by the higher discount rate. Countless beginners were wiped out because they mistook a decade-long monetary experiment for an immutable law of physics. They only knew how to navigate a calm sea, and they drowned the moment the tide went out. So, where does this leave us today? And how does this affect the broader global economy? We are currently navigating a profound macroeconomic shift. We are moving away from an era of seamless globalization, abundant energy, and perpetually cheap capital. We are entering a multipolar world characterized by supply chain friction, structural inflation, and a normalized cost of capital. The passive blind faith investing strategies that worked in the zero interest rate environment of the 2000s will not save you in the 2020s. Governments are running massive deficits. and central banks are actively trying to balance economic growth with the persistent threat of inflation. In this environment, the market will be exceptionally unforgiving. To survive, you must strip away the illusions. Do not be seduced by nominal yields without understanding the risk premium. Never fund a long-duration asset with short-duration liabilities. Recognize that liquidity is a conditional privilege, not a permanent right. Always ask yourself who the institutional counterparty is and why they might be eager to sell what you are so desperate to buy. And above all, study financial history because the mechanics of money do not change, only the faces of the players do. The market is an entirely emotionless machine. It does not know who you are, it does not care about your retirement goals, and it will not reward you just because you need the money. It only respects one thing: your rigorous alignment with economic reality. Avoid these 5 systemic mistakes, respect the mechanics of the machine, and you will transform yourself from exit liquidity into an enduring investor.